With total net sales hitting 9.32 billion euros, you would expect ASML to be swimming in cash, yet liquid reserves are rapidly evaporating. Is this simply an accounting illusion, or is the most important technology firm facing a hidden liquidity trap? When you look at that 9.32 billion euros, representing 21.2% year-over-year revenue growth, the underlying story seems flawless. The crowd assumes this top-line surge proves the global infrastructure build-out is accelerating, specifically those massive physical data centers. But when you dig into accounts receivable, which skyrocketed 140% to 7.25 billion euros in 6 months, a different picture emerges. The company is booking record sales, but actual cash from those physical lithography machines has not arrived yet. Once you grasp this divergence, you will view financial reports in a new light. Despite a current ratio of 1.33 times, this extreme buildup reveals management is allowing customers to extend payment terms, strategically prioritizing market share dominance over short-term liquidity. To understand why the business waits patiently for cash, look directly at their extraordinary pricing power. Operating margin expanded to an elite 37.1% for the second quarter, proving their pricing leverage remains intact. Headlines scream about this 250 basis point operating margin expansion as a standard earnings beat. However, maintaining that exceptional profitability requires context when you remember the United States inflation rate still sits at 3.5%. ASML possesses absolute monopolistic pricing power within the industry. By forcing foundry operators to absorb higher costs without sacrificing volume, the firm demonstrates peak operational leverage, generating a gross profit of 5.04 billion euros this quarter. That unquestionable dominance makes the next financial metric incredibly jarring. Management reported a staggering 5.67 billion euros in 6-month net income, boasting a highly impressive 31.3% net margin. Casual commentators focus purely on this bottom-line profit, assuming the company is bulletproof right now. But the fundamental reality hides in their operating cash flow, which plunged to a negative 482.5 million euros over the exact same period. This alarming divergence is driven entirely by a 6.77 billion euro working capital absorption, meaning massive cash is trapped in unpaid invoices. This disconnect between headline profit and actual operating cash flow reveals a business burning tangible liquidity to sustain operations. While their second quarter free cash flow margin sat at a healthy 15%, the broader 6-month trend is bleeding out heavily. This illustrates why seasoned investors always prioritize free cash flow over headline earnings per share. This brings us to the elephant in the room regarding their immediate financial armor. Total cash and cash equivalents plummeted 48.3% in just 6 months, a shocking drop for a market leader. Surface-level chatter completely ignores this dynamic, hypnotized by the impressive headline earnings per share of 7.58 euros. Watching cash reserves drop from 12.9 billion euros down to 6.67 billion euros strips away a significant portion of the firm's safety net. A continued bleed inevitably forces a conversation about balancing aggressive corporate growth with basic financial safety. Despite that rapid cash bleed, capital return to investors hit an aggressive 3.73 billion euros through dividends and stock buybacks in 6 months. Most analysts view this massive payout as a supreme sign of corporate strength, but funding 1.08 billion euros of quarterly buybacks from dwindling cash reserves rather than organic operating cash flow is a fascinating high-wire act. It clearly signals ASML views the current cash flow dip as a temporary timing mismatch. You must decide if this aggressive shareholder return policy is a masterstroke of value creation or a dangerous depletion of vital resources. Fortunately, the business has a highly underrated financial cushion protecting them from this temporary cash burn. Long-term debt was aggressively paid down to just 1.98 billion euros over the last half year. While observers fixate on explosive revenue momentum, the true defense mechanism is the resulting debt-to-equity ratio of 0.09 times. At first glance, this looks like conservative accounting, but near zero leverage is the unsung hero of the financial report. This ensures the company faces absolutely no solvency pressure despite the negative cash generation we just analyzed. By operating essentially debt-free, management maintains strategic autonomy to weather payment delays from their semiconductor clients without bowing to credit market volatility. And those elite clients are definitively buying, explaining the massive physical scale of this global operation. The delivery of 91 lithography units in the second quarter provides hard physical evidence of the ongoing hardware boom. Comparing this to the 76 lithography units shipped in the prior year period grounds the technological revolution in heavy industrial manufacturing rather than speculative software valuations. Every single unit shipped represents a massive multi-million-dollar commitment from global foundries. To keep up with this relentless demand, ASML is placing a financial bet on future manufacturing capabilities. With the United States GDP growth rate at an annualized 2.1%, providing a stable macroeconomic backdrop, the firm is expanding production for domestic ventures. Wall Street is captivated by the narrative of new high-volume production facilities, like the anticipated Texas manufacturing projects. However, executing this long-term roadmap requires heavy upfront capital expenditures today, like the €299.4 million spent on physical property and equipment in the second quarter. This creates a compelling growth runway but ensures the company's cash flow remains under intense pressure while they build the foundational factories of the future. The justification for all this heavy forward spending comes down to maintaining their absolute technological monopoly. This monopoly protects that elite 37.1% operating margin from any competitive pricing threats. The successful integration of next-generation extreme ultraviolet lithography machinery into upcoming commercial processors permanently validates their expensive research strategy. At first glance, critics previously worried about the astronomical adoption costs of these entirely new systems. But this commercial deployment effectively silences those lingering doubts, securing a vital moat that locks out competitors and guarantees future revenue growth. So, how do we reconcile the explosive 21.2% revenue growth with the glaring cash flow deficit we uncovered at the very start of this analysis? The fundamental truth is that ASML is operating in a unique state of aggressive hyper-expansion. Building the physical infrastructure of tomorrow requires absorbing that massive €6.77 billion working capital friction today. The firm purposefully allows its elite clients to extend payments, knowing full well that no competitor can offer a viable alternative to their exclusive technology. The headline numbers might look slightly contradictory at first glance, but the underlying mechanics reveal a brilliant strategy. It is a highly calculated game of absolute market dominance prioritized heavily over short-term liquidity optimization. For the intelligent investor, the current stock valuation rewards extreme patience and a deep understanding of balance sheet dynamics. This is not a dangerous value trap, but rather a world-class compounding machine boasting a 31.3% net margin, temporarily caught in a working capital bottleneck. As those €7.25 billion in delayed accounts receivable finally convert into hard liquid cash over the next few quarters, the financial statements will violently realign to reflect their true profitability. Keep a close eye on their upcoming collection cycles, but recognize this company remains the undisputed tollkeeper of the digital economy. But I want to hear your take on whether this aggressive cash burn is a brilliant long-term bet or a dangerous overextension in a shifting market. Let me know in the comments. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.